Hey y'all, welcome back to the channel. Today we're going to be talking about 6 investment terms and we're going to explain them for new investors that maybe haven't heard them before. Before we get started, I just want to clarify that this content shared here is for informational and educational purposes only. I'm not a certified financial advisor. The information should not be taken as professional, financial, or investment advice. Always do your own research or talk to a licensed expert before making any more choices. Thank you. Let's get into the video. Firstly, we have the PE ratio, which stands for price to earnings, and it's basically an indicator on how much investors are willing to pay per dollar of earnings from a corporation. It usually indicates like a stock's value. So is it a growth stock or is it a value stock? The lower the PE ratio or the lower the number, the cheaper it is because you're paying less for dollar of earnings. Okay, so how do you calculate the PE ratio? It's actually pretty simple. So firstly, you take the stock price or the share price of the stock and you divide it by the EPS or earnings per share, and that's how you get your PE ratio. An example of this, so let's look at Amazon stock. So as of recording, the share price for Amazon is $272 and its EPS is 12.4. So if you divide 272 by 12.4, you get its PE ratio of 22.3. Okay, so next up we have the PS ratio, or which stands for price to sales. And it basically shows how much people are willing to pay per dollar of sales or revenue. It's another way to value a company similar to PE ratio, and similar to PE ratio, again, the lower the cheaper, and vice versa. Okay, so how do you calculate PS ratio? There's two ways to do it. So you can do it on a per share level, take the share price and divide it by the revenue per share to get your PS ratio. Or you can do it on the company level, take the market cap of the company, divide it by its annual revenue, and then you have the PS on the company level. A per share example for Amazon stock, current share price as of recording is $272 with an revenue per share of 72.3. So that gives it a PE ratio of 3.76. So how are PE and PS ratios similar and how are they different? Firstly, they're both used to value a company. They can be used to determine whether they're over or undervalued, whether it's a value or growth stock, whether there's growth potential, or there's a value opportunity because it's undervalued by the market. But where they differ is with PE ratios, it compares stock price to its per share net income / profit. PS ratio compares stock price to its per share revenue / sales. So the difference is they're comparing a company's profit per share versus revenue per share. Next up, we have market capitalization, usually referred to as market cap. Now, very simply, market cap or market capitalization is simply the total value of a company. So, for example, Apple's market cap is $4.54 trillion because that's how much the company's worth. Same thing with NVIDIA sitting at $4.86 trillion. Calculating market cap is actually very simple. All you do is take the share price, times it by the number of shares, and then you have your market cap. So with Alphabet or Google, there's 12, as of recording, there's 12.23 billion shares outstanding, and their price per share, or PPS, is $362, which gives it a $4.62 trillion market cap. Next up, we have trading volume. So trading volume basically means how many shares are traded in a given period, which is usually like a day. So trading volume usually measures a company's liquidity and shows how liquid a company is by showing how many shares are being exchanged. When I say traded or how many shares were traded in a day, traded usually just means how many shares were bought and sold. So we can see this if we look at Google stock. The 10-day average trading volume as of recording has been 37.71 million shares. So basically, on average, over the last 10 days, around 37.7 million shares have been bought and sold of Google stock. Next up, we have dividends. So what are dividends? Dividends are an incentive corporations give their shareholders for simply owning shares. Now, they can be paid, they're basically a cash incentive, and they can be paid as additional shares or in cash. The distributions, which is basically when they pay out the dividends, can be weekly, monthly, quarterly, which is basically every 3 months, or annually. An example of a well-known dividend stock would be Coca-Cola with the ticker KO. So as a recording, price per share, $86.79. And dividends, when it says dividend yield, so dividends are kind of calculated as a percentage of the share price. So when we're looking at the dividend payout per share of Coca-Cola, we multiply the share price by the dividend yield or percentage of the share price to get $2.12. 86.7 times 2.45% equals $2.12. So that's how you calculate your dividend. So as we talked about earlier, you can either get your dividend payment in cash or you can get it in additional shares. When it comes to DRIP or dividend reinvestment plan, this is where we talk about when you get it in additional shares. So if you choose to get your dividend in additional shares, you now own more stock in the company, which entitles you to more dividends and more share appreciation. So it has this sort of compounding effect of where the additional shares you get this year are shares that next year you get paid more dividends on, and it kind of compounds and grows and grows and grows. So when people talk about the benefits of dividend investing, they usually talk about DRIP and how you can accumulate more and more shares without actually buying more shares. So now let's look at a stock's beta. So beta is essentially a measurement of a stock's volatility relative to the broader market. So the base beta score, which is supposed to represent the overall market, is 1, and that's the score attributed to the S&P 500. So any score below a 1 is considered less volatile or less risky than the overall market. Any score above is vice versa, more volatile, more risky. So beta scores can also be negative, which means that they have a negative correlation to the market. If the S&P 500 goes up, this one will go down. If the S&P 500 goes down, this one will go up. Two popular companies with betas, or an example of beta, would be Tesla with a 2.19 and Amazon with a 1.4. So let's say the S&P 500 goes up 1%, Amazon would go up 1.4%. If it went down 1%, Amazon would go down 1.4%. All right, y'all, this is the end of the video. Thank you so much for watching. If you have any questions or comments, please feel free to leave them in the comment section. I'll be happy to answer them. Thank you so much.